If you want to build wealth, you have to be investing. You've probably heard this or something similar from a friend or family member before. And if you're like me just a few years ago, you probably have no idea where to even start. Well, you've come to the right place. Let's change that. Hi, my name is Daniel, a retired Meta software engineer, and this is my channel, Gainfully Unemployed, where I talk about personal finance and investing from a technical and first principles perspective. In this video, we will look at investing fundamentals. What is a stock and the stock market? How do you pick one to invest in? And what other investment options do you have available? When we're talking about investing into the stock market, one of the most fundamental concepts to understand is that of a stock. A stock, also known as an equity, is security that represents a fractional share of ownership into a company or corporation. This entitles the owner to a proportional share of the company's profits and assets. The unit in which stock is denominated are shares. Or to put it more plainly, when you are buying stock in a company, you are buying a share in the actual business of that company. If the company is successful, increases its profits, and grows its valuation, then your investment in the company will grow proportionally. But if the company underperforms, books losses, and loses valuation, then your investment will decline accordingly. And if the company goes under, then your stock will be worth nothing. Yes, investing is risky. And in an efficiently priced market like the stock market, your potential returns are generally a function of the risk that you're willing to take. We will talk about how to adjust risk, both up and down, in a later part of this Investing 101 video series. For now, know that you are taking a risk with your hard-earned money if you are investing it into the stock market. But in return, on average and over a long time horizon, you can expect a return on your investment, also known as ROI. And due to factors like inflation, not investing your money will not risk losing it, but will guarantee that you will do so. On average, US stocks yielded a inflation-adjusted, annually compounded return of roughly 7%. Compare that to the 3% annual loss that you have incurred through inflation alone. So your friends are probably right when they tell you you should invest in stocks. But how do you even buy stocks? Well, at the stock market. Most trade and exchange of stocks happens on the public stock market, like the New York Stock Exchange. Billions of shares are being traded on the major US stock exchanges on a daily basis. Companies list their stock at an exchange in a process called IPO, or Initial Public Offering. Sellers, as well as buyers, make their price offers at an exchange in the form of an order. The most competitive price offer by sellers is called the ask, and the most competitive price offer by buyers is called the bid. These offers are tracked for each stock listed at the exchange in what is called an order book. If the ask and bid for a stock do not match, then sellers and buyers do not agree on a price and no trades can happen. The difference between ask and bid is also called the spread. When ask and bid match, a fair market price for the stock was found, and the trade settles at the given price. The buyer acquires the shares from the seller. Historically, all this price finding and trading was done by brokers on the stock market floor. Today, virtually all of it happens electronically. But to get your sell and buy orders in, you still have to go through a broker. A broker is an individual or a firm that will list your order on a stock exchange order book. A broker might also arrange or provide custodian services for your stocks, meaning they will hold and store, these days all electronically, and manage and track your stock and other securities, similar to how a bank does for your money in your bank account. But most importantly, a broker will enable you to buy and sell stocks. There are dozens, if not hundreds, of brokers in the US alone that you can simply sign up for an account at. Charles Schwab, Fidelity Investments, and Robinhood are just some popular examples that you have probably heard of before. To actually start buying and investing in stocks, you will have to create an account with one of these brokers. You can find a link to create an account with Robinhood in the description below. Robinhood is a great beginner-friendly option. Once you've created a brokerage account, you will need to transfer some money into that account. Once that money has cleared, you can begin buying and selling stocks. Robinhood simplifies this process significantly for you. For most other brokerages, you will have to wait up to 3 business days for your money to clear. With Robinhood, your money will be available for buying stocks basically immediately. In addition, most other brokerages will require you to specify exactly what type of order you want to place and for how many shares. Robinhood, on the other hand, will just ask you how much money you want to invest and then default to a market order for you. We will talk some more about all the different types of orders in a future video in this series. For now, know that a market order basically just buys or sells at the best available prices on the order book and is a good option if you're just starting out. So far, all of this is great. But what stocks should I buy? How do I tell a great stock from a bad one? And how do I choose? I'm glad that you asked. We briefly touched on risk before, and buying any individual stock puts you at risk. The risk of losing your investment. And while there are many companies that are unlikely to just go out of business tomorrow, any particular investment might perform badly and might lose significant amounts of value at any time. We're going to take a closer look at how to evaluate businesses and individual equities in a future video in this Investment 101 series. Make sure to subscribe to my channel to not miss out. So the best stock choice for now is not a stock at all. It's an index fund. To understand what an index fund is, we need to first both understand what a fund is and what an index is. A stock index is a selection of stocks that tracks the overall valuation of those stocks. Some well-known indexes that you might have heard of are the S&P 500 or the Dow Jones. Each index has its own rules and process on how stocks are selected to be included in the index, as well as how the stocks within the index are being weighted against each other. But in the end, the index produces a single valuation number that represents the overall valuation and performance of all the stocks included in that index. This makes indexes very useful to see how the companies included are performing overall, without having to focus on any individual company. A fund, on the other hand, in its most basic form, is just a pool of money allocated towards a specific purpose. In the case of an index fund, that purpose is to buy and closely track the overall performance of all the stocks included in that index. When the index valuation increases, then the index fund valuation increases. When the index valuation decreases, then accordingly, the index fund's valuation will decrease as well. Funds are either managed by a fund manager or electronically by what is effectively a computer program. Index funds tend to fall into the latter camp. For the service, funds charge a fee that is taken out of the fund's cash pool. Index funds are typically cheaper because they are managed electronically and can be as low as 0.2%, whereas managed funds are more expensive and can easily charge up to 1% annually in fees. There are also different structures for funds, like mutual funds and ETFs or exchange-traded funds. I'm going to go into more detail on both indexes and different fund types in the next video in this series. For now, know that ETFs function more like stocks in regards to how they are evaluated and how they are traded. And index funds are generally cheaper than managed funds. Each major index has many different funds tracking its performance. The most well-known ones are probably SPI for the S&P 500 index and QQQ for the Nasdaq Whole Market Index. By investing into an index fund, you can mitigate some of the risk associated with investing, and especially the risk with any particular company underperforming compared to the rest of the market. Thank you for watching this first video in my Investing 101 video series. In this video, we learn about what stocks are and how they are traded at the stock market, how a broker can be used to participate in this exchange, and how index funds can be utilized to mitigate some of the largest investment risks. If you found this video useful or learned something new, please leave a like. Unlike stocks, they cost you nothing. If you have any questions or feedback to give, please leave them in the comment section below. Go ahead and subscribe for more educational and technical videos on personal finance and investment from me. Hit the little bell icon to get notified as soon as I upload new videos. Thank you for watching. I am Daniel, and this is my channel, Gainfully Unemployed.